My name's John Stopford. I'm co-head of fixed income at Investec Asset Management. I'm also the portfolio manager of our emerging market multi-asset strategy. And I want to talk to you today about why we think emerging markets are worthy of consideration and the different ways in which you can access emerging markets. And then we'll hopefully have time for some questions towards the end. So why do we think you should consider emerging markets? Generally, our sense is that investors typically are fairly underinvested in emerging markets. Historically, obviously, most of people's assets are in developed markets, obviously predominantly in home markets, but also in global developed markets around the world. Our sense is the world is changing fairly dramatically and fairly permanently. And that's not yet reflected in how people are positioned in terms of pension investments and other investments around the world. We think emerging markets in particular have some characteristics which mean that the return potential available is likely to outpace the return potential available in developed markets, and the riskiness of investing in emerging markets is diminishing, whereas perhaps the riskiness of investing in a number of developed markets is increasing. And I'm just going to give you a couple of taster slides in terms of things that we think are behind the relative potential in emerging markets and the change in the risk environment. So this first slide is really focusing on one of the key drivers of growth. So emerging market growth, as I'm sure you're all aware, has outpaced developed market growth substantially over a number of years. And two of the main drivers of that, one has been demographics, i.e. emerging markets basically are areas where there are lots of young people and people moving from agriculture into the cities and so on, whereas the developed world, as we know, is an increasingly aging population, and that brings problems, but it also generally diminishes the potential rate of growth of an economy. So to give you some statistics, something like 1.6 billion people will become urbanized in the next 15 or 20 years. And most of those will be in emerging markets. Something like 1 in 4, or possibly slightly more than 1 in 4, of every job seeker over the next 5 years around the world will be an Indian. There are lots of people out there who are looking for work, who are going to work hard, and part of the growth of emerging markets and the excitement in emerging markets is that demographic boost, alongside really a catch-up potential. So emerging markets are at an earlier stage of development. The ability of them to raise productivity and to grow faster is there. And it's helped by things like technological change. So the fact that in Africa you can probably get better cell phone reception than you can in Newport, or globalization, the fact that people are now buying stuff from all over the world and doing business with each other, and economies are opening up. Those are things that have allowed this potential to come to the fore. So what does the potential look like? This is just showing relative shares of global growth over recent times and going forward. So we're in a world where something like 70% of economic activity or increases in economic activity are taking place in the emerging world. So this is a part of the world that currently represents something like a third of global GDP, and over the next 20 years or so is going to represent over half of global GDP. It certainly, I don't think, represents anything like that in terms of people's investment portfolios. At the same time, the other thing that excites us about emerging markets is they're becoming less risky. They're becoming more safe, more developed, and at the same time, some parts of the developed world are going into reverse. So emerging markets, they had their global financial crisis in the late 90s. So we had a number of defaults. We had a Russian crisis, Russian default, Mexican peso crisis in the mid-90s. We had Argentina defaulting in 2001. They had a whole episode where they'd been badly managed for a long period of time. They built up large debts. They were reliant on foreign borrowing. They had current account deficits. Growth was mediocre. And they had lots of problems. The end result of that crisis is they had to think again. They had to think, how do we actually turn ourselves around? This is not sustainable. And they went through a whole process of reform, reforming fiscal policy, monetary policy, trade, governance, everything. And the net result is they're now generally well managed. Most economies have fiscal targets, they have monetary targets, economies are growing nicely, and part of the growth has come from unleashing that potential through reform, through doing things better. At the same time, we know in the West, we're now in the midst of our financial crisis, and it's going to take some time to repair, and there are some big headaches along the way. So this chart just shows government debt to GDP across emerging economies at the bottom, and the average emerging economy has currently borrowed something like 40% of its GDP in terms of government debt, but that's declining. And as we know, if we look at the developed world, we've currently borrowed something like 100% of GDP, and it's growing. So we're all sitting here with large budget deficits and no real plan of how to sort it out. Emerging markets stand in stark contrast to that, and as we'll see, the credit quality generally of emerging markets is improving pretty quickly. So they promise decent growth. They have improving management, and that's being shown in terms of the sort of hard statistics that come out. At the same time, typically they offer a higher return. So you're in a nice position where something that historically people used to think that was risky and is now becoming less risky pays a higher yield than something that people always used to think was safe, i.e. developed markets, and now looks increasingly uncertain, obviously looking at Greece, Italy, Spain, Portugal, etc., not to mention our own problems in the UK. So on average, you're paid something like a 4.5% additional yield for lending to an average emerging market in its own currency, and you're paid something like 3.5% lending, additional return, additional yield, lending to it in a hard currency, in a developed market currency. So decent starting yields, return potential from better growth, return potential from structural improvement. At the same time, they don't really need our money. They have turned themselves around. They've gone from being current account debtors 15 years ago to, on average, being current account surplus nations. They have very high savings rates on average. That saving can then be applied to growing, to investment. They're actually net exporters of capital. They're funding us, not the other way round. And what that means is it means that they are less volatile these days when you have a shock, because they're less reliant on foreign savings to push their asset prices up or down, or to grow their economies. It also means typically most of their currencies are undervalued, and there's scope for real currency appreciation from just revaluation of currencies over time. We've seen that across many emerging markets over recent years, and we would expect that trend to continue, coupled with the fact that higher productivity growth, this catch-up that we expect, or we are seeing, also can allow currencies to trade higher in real terms. So that really brings us on to how you can access emerging markets, how you can play the opportunity. And the two opportunities that we think are key, it's not just about growth. Growth is important, but it's also about structural reform. It's better quality growth, it's safer investment, and in some ways the two are linked. We wouldn't, I think, have had the improving growth outlook in emerging markets over the last 10 or 15 years if the reform process hadn't happened first. So one preceded the other, or at least released the potential of the other. Those two drivers impact emerging economies in a range of different ways, and that impacts asset classes in a range of different ways. So if you're looking at the macroeconomic strength side, some of the things we've seen, falling inflation, that's been a big benefit to emerging markets. But if you're a bondholder, it's been a particularly big benefit. You've benefited from falling interest rates and falling yields, which has pushed up local government bond prices. It's also meant that they're borrowing less, fiscal policy stronger. So investors are demanding less of a risk premium, less of a yield premium for owning those markets. And again, you've had capital gains from narrowing spreads or narrowing yields due to fiscal policy. And then balance of payment strength, we've mentioned, that's helped push up emerging currencies, and they've generally been a very strong performer on average over the last 15 years or so. On the growth side, then you can start looking at asset classes like equities. Clearly, stronger growth on average typically will be good news for emerging market equities, particularly, obviously, if it feeds through into higher profit growth, and we've seen that across emerging markets. Interestingly, it's not always a direct relationship. So some of the biggest beneficiaries in emerging market equities over the last decade or so have not been necessarily some of the obvious places. China hasn't been a great investment despite it being one of the fastest growing economies. But economies like Brazil, or equity markets like Brazil, South Africa, South Korea, have effectively all piggybacked off the growth in China, and their stock markets have done phenomenally well. Higher productivity growth is also good for currencies, we mentioned that. Emerging market corporate debt's beginning to open up. So at the moment, if you buy corporate debt, you're going to be lending to developed market companies, and some of those are very good. Emerging market companies, on average, are seeing improving credit quality and typically will pay you a higher yield for the same level of risk. So you're seeing better quality companies coming to the market and paying higher yields for the privilege of borrowing from you and your funds. And then finally, the other way in which emerging market growth is playing out is in commodity prices. We all experience higher petrol prices at the pump. We all experience higher food prices. You can benefit from that either through the equities or through the commodities themselves. And so looking across emerging markets, there are at least 7 different ways in which you can play different aspects of emerging markets. That's interesting in the sense that then you can start to think about how do those different options fit into a portfolio. You don't have to just play equities, you can play bonds, you can play credit, you can play currencies, you can play corporate bonds, commodities, and so on. So I'm just going to touch on a few of those. Oh, sorry, the final point just on this. Obviously, the other thing you can do is blend these together into a multi-asset strategy, so into a more balanced strategy, a mix of bonds and equities. And I guess the opportunity there is you then have the opportunity to asset allocate, pick what is the best way to play these at any moment in time. You can do that as a fund, or you can outsource that to somebody else who you think might have better knowledge or better experience in terms of deciding at different moments in time which of these different aspects is going to play out most positively across emerging markets. So just looking at emerging market equities, most of you will have exposure to emerging market equities. You might not realise it, I'm sure you probably do. It's probably coming through your global equity manager. So if you're in MSCI ACWI or something like that, there's a component of emerging markets. It's typically underrepresented on sort of current market cap, on current GDP. It's certainly underrepresented on where emerging markets are going in the future. The good news about emerging market equities is they can be a great ride. You can see the returns over time. At a time when developed market equities have looked pretty sick, emerging market equities have done relatively well. It's a broad universe, lots of companies to choose from, so there's lots of opportunities for stock selection, lots of opportunities for country selection, sector selection, and so on. The downside of emerging market equities is they're incredibly volatile. They're much more volatile than you would experience holding FTSE stocks. So they need to be thought of in terms of how that fits in with a portfolio. Potentially high return, and we would expect them to be one of the better returning asset classes globally over the next decade or so, but coming with a fair amount of risk. You can, though, obviously play emerging markets in other ways, as we've shown. Hard currency debt is probably the way that emerging markets have been played for the longest. So this is where borrowers like Brazil funded themselves in the sort of 80s and 90s during their sort of crisis periods. People didn't lend to Brazil in local currency, in Brazilian reais. They lent to Brazil in dollars. The good news about hard currency debt is generally the quality of the countries you're lending to is improving. Emerging markets are a broad church. There are something like 40 different countries represented in the main emerging market debt index. Some of them aren't good. Some of them you want to avoid. But on average, you're seeing improving credit quality and you're being paid a decent yield for that risk. And you can see in the chart on the right-hand side, that dark blue patch is the composition or the proportion of the index, the JP Morgan index, which is rated investment grade, which is rated triple B or above. And you can see it's gone from basically 0 20 years ago to about 50% of the universe. And the light blue and the dark grey bits are the riskiest part, and they've gone from about 40% of the universe down to about 5 to 10% now. So significant change in quality and a fairly steady trend since the financial crisis. So at the same time that Greece has gone to CCC and defaulted. Portugal's gone to junk. Ireland's got close to junk. Italy and Spain have got close to junk. You've had something like 40 credit rating upgrades across emerging markets. So generally, despite the fact we're in a more difficult world now, that trend of improvement has continued. The better quality or the more established emerging markets then also borrow in their own currency. They have enough credibility that they can be like the UK Treasury and they can borrow in their equivalent of the gilt market. And then again, you've got typically 10 to 15 different well-established markets. You can choose between them. Some are better, some are worse. The good news is typically they still pay you a real return. So unlike gilts, where you get a negative real return and negative yield adjusted for inflation, in these countries they're still paying you a risk premium. They're still paying you a return premium, despite the fact, on the whole, they increasingly look better managed than most developed economies. In addition to paying a real return, if you buy bonds in local currency, you get the benefit of any currency appreciation, and we think that is a significant potential component of any emerging market return. So currencies that are linked to stronger economies, paying higher yields with good balance of payments positions and faster growing productivity generally should see themselves outperform against currencies like the dollar and the euro, particularly when their central banks are tending to print more of those currencies and effectively look to devalue them. So you can play the currencies themselves. You don't have to buy any bond markets. One of the ways that some people like playing emerging markets is actually buying a diversified basket of currencies. The rationale for that is it's actually a relatively low risk. It's a sort of global cash alternative, and you can see it's been a fairly steady performer with relatively low volatility historically. All of these charts are cumulative returns in pounds, and it's pretty broad universe to choose from. About 20 different markets are readily tradable. Generally, in emerging markets, you've got new countries coming onto the bench the whole time, and often they offer higher potential returns, and as they become tradable, you can exploit those as well. And then finally, emerging market multi-asset. So you can choose any of the individual pieces, work out how they fit in your strategy, or you can say, I like the emerging market concept, I'd like to allocate to emerging markets in general, and then have somebody decide how that allocation should be adopted through time. The bar down the bottom just shows some of the breadth of this opportunity. One of the exciting things about emerging markets is you've got a lot more choice. Developed markets, increasingly, particularly now that so many countries are bundled together in the euro, there aren't so many markets that you can choose between. In emerging markets, you've got lots of different markets at different stages of development with different economic models. Some are commodity importers, some are commodity exporters, some are high-end manufacturers, some are very agrarian, etc. So there's lots of different choice. So EM equities, about 21 countries in the main index, but then a whole load of smaller markets outside. Local currency bonds, about 20. Currency markets, 20-odd. Hard currency markets are over 40. So opportunities to manage within that market, choose between different opportunities, different stocks, different holdings, and then asset allocate at a more top-down level between bonds and equities, we think is pretty significant. So how do the different asset classes stack up historically? Clearly, the past and the future are going to be different. We would argue that probably returns will be lower going forward. So some of the re-rating that we've seen in emerging markets has boosted historical returns, and yields generally are lower. But we would also argue that returns prospectively in developed markets are probably significantly worse than they have been historically. Just look at gilt yields. You don't have to look very far to see that return potential everywhere around the world is probably lower than it was in the past. At the same time, I think it's reasonably plausible that emerging market equities can deliver double-digit returns, and emerging market debt can deliver something close to high single-digit returns, and multi-asset somewhere in the middle. Risk characteristics, though, we think are relevant. They tend to be more stable through time. You'll notice from the left to the right there are two different periods. The longer period on the left, volatilities were a little bit higher. They've tended to come down over time as some of that structural improvement has come through. The other point we would make is you can probably see just how volatile emerging market equities have been. In the earlier period, that was the period when everything was wrong with emerging markets. high debt, low growth, high inflation, lots of defaults, badly managed economies, badly managed companies, emerging market equities were a bit of a dog. Post the reform process over the last decade, they've been the best performing asset class available. But that move from top to bottom, or roughly top to bottom, gives you a pretty clear indication of the volatility of emerging markets, and you can see it in the standard deviation number. So over 20% annual volatility over the last decade in emerging markets. Emerging market debt's been a much more stable investment, so top over the last 20 years, and then sort of third and fourth over the last decade. Much more consistent returns for lower volatility. Obviously going forward, maybe slightly lower returns than that. Generally, though, ahead of global developed market assets. So global equities are developed market equities, global bonds are developed market bonds. And then emerging market multi-asset then has done quite a nice job of basically being never at the top, but certainly never at the bottom, giving you a mix of the outcomes in emerging markets, and with a much more reasonable level of volatility compared to equities. So very similar to the kind of volatility that you get from domestic equities. So global equities, standard deviation about 14%, very similar to emerging market multi-asset, but the potential returns, hopefully we've convinced you, can be significantly better and more likely to be better going forward. So we would suggest, if you haven't looked at emerging markets, you should. We think the growth story is pretty compelling. It's being liberated, or it's being galvanized by the reform process, and then there are lots of different ways to play emerging markets. They all have their merits. You can either look at those individually, or you can look at a blended strategy like emerging market multi-asset. One final slide just on us. Who are we? Emerging markets are in our blood. Investec Asset Management started in an emerging market about 21 years ago. We've grown organically since. We run about $100 billion. Over half of that is in emerging markets. We do all of the things we've talked about. So if you want to talk to somebody, please feel free to talk to us. There'll be other people here, I'm sure, who are also happy to talk to you. Roughly half of our investment professionals are focused on different aspects of emerging markets. And then we also have a developed multi-asset capability, having managed global and emerging market multi-asset portfolios for the last 20 years or so. So it's more than enough for me. Thanks very much. Do we have any time for questions? I think we've probably got about 10 minutes if anybody's got specific questions or even general questions about EM. No? Oh, yes?
Jeff Reader from Bedfordshire Pension Fund. Jeff Reader from Bedfordshire Pension Fund. Quick question about emerging markets, really. As you say, they're going to get a lot better. So what does emerging markets really mean as a label? Because surely some of them will become developed.
Yeah, I think it's a good point. I think the labels DM and EM are increasingly becoming meaningless. The reason why it's maybe still worth talking about emerging markets is because people are underrepresented in terms of portfolios. So their portfolios historically and currently are still very DM concentrated. In the future, you can definitely see a time when it's more of a function of risk markets and defensive markets, or good markets and bad markets. And within emerging markets, there are definitely bad markets. There are just more good stories than bad stories. And in developed markets, it's the reverse. So, where do Italian government bonds fit into a portfolio these days? They're clearly no longer a defensive asset. Maybe Korean government bonds are increasingly a defensive asset. So I think things will change. I think in the short term, on a sort of 5-year view, there's still such a long way to go between how people are invested today and maybe what an optimal asset allocation is, that it still makes sense to talk about EM. In 5 years' time, hopefully we'll just be talking about broad global equities, broad fixed income, broad multi-asset, and people won't be so hung up on the labels.
One of the current buzz issues is increasing monitoring of voting performance of managers and the companies we're investing through. How does that stack with ability to monitor performance on that side of things with companies in emerging markets?
I think it's a very good question. I mean, we've thought quite hard about the whole issue of responsible voting and making sure that we're active participants in shareholder votes. And I think we've also focused quite hard on making sure that we understand governance issues in these markets. So there are more complications, I think, in investing in emerging markets than some developed markets, but those are changing. And I think with the modern age of technology, the modern age of the internet and so forth, it is much easier to keep track of these companies. And within the global equity universe or emerging market equity universe, you're typically talking about, larger companies who are very well able to deal with global investors. And we would interact with them on a very active basis. So our equity managers are very focused on both how we vote, and we have a team dedicated to looking at voting issues, and then also making sure that we understand any governance issues that may exist in particular markets or particular sectors.
Keith Bray, Local Authority Pension Fund Forum. On one of your slides, you had two pie charts showing the analysis by sector and by country. Which tends to drive your investment strategies? And secondly, looking at the one on sector, has the sector analysis changed much over the last 5 or so years, and are you expecting it to change much in future?
Okay, both very good questions. I would say, in order of importance, it's actually bottom-up stock selection within equities that matters. So it's looking at individual companies and how they stack up. We have something called a four-factor approach, where we're looking at a range of things that we think determine a good company. So things like the quality of their earnings, valuation, and so on. So we rank every equity in the universe on that basis, and in emerging markets we also include a factor for the governance aspects of things. So we're more focused on trying to identify where are the best investment opportunities, and then make sure that we don't have too much concentration by sector or by country. Sector is probably the next most important, because an oil company in one economy and an oil company in another are probably more related than an oil company and a bank, or an oil company and a consumer business. So sectoral exposure is something that we monitor closely and will take views on, and we may skew portfolios towards or a particular sector, look for more good companies in a particular area if we have a strong view there. Country is a difficult one. Generally, if you try and impose too much of a top-down view from a country perspective, the danger is you get it wrong, because will the sort of macroeconomics of that country feed through in a fairly obvious way to the average equity in that country, and it might depend on what kind of sector makeup it has, whether it's more of a commodity-related economy or whatever. So, for example, I mentioned China. Chinese equities have been a bit of a dog, but you could play Chinese equities indirectly through commodity companies. So if you picked the right commodity companies, you got much better returns than trying just to overweight Chinese equities. So I think bottom-up we think is much more important on the equity side, and then its sector and country is really an aggregation of what you end up with. How's it going to change? I think the main things that are going to change, emerging markets are going to become much more consumer-orientated. So historically, emerging markets were, the engine rooms of the global economy in terms of manufacturing. They were the source of raw materials for growth and so on. Increasingly, economies are becoming much less dependent on that, and building middle classes, building domestic consumer demand, and building domestic consumer brands. So as an example, China now has overtaken the United States as the second largest market for luxury goods in the world. So Chinese car consumption is rising at something like 25% per annum. So there are big opportunities for consumer industries and consumer brands to build in emerging markets, and we're beginning to see that. On the other side, I think gradually resources will probably become less important, although I think they'll still remain reasonably important.